So for our presentation today, I will cover the type of account and strategies that as Canadian tax residents can use to save for retirements. Okay, so for the first part, I will cover the type of plan we should use to save for our retirement, including its features and benefits. There are several registered plans in Canada that provide tax benefits, including the Registered Retirement Savings Plan for long-term retirement purposes, the tax savings account that allows you to accumulate your wealth and earn income tax-free, the Registered Education Savings Plan to accumulate savings for your children's education after high school, and the Registered Disability Plan for beneficiaries who qualify for the disability tax credit. And as for today's presentation, we will focus on the Registered Retirement Savings Plan, also known as the RSP. However, if you would like to know more about the TFSA, RESP, and RDSP, please feel free to contact me at the end or after the session. So many Canadian tax residents choose RSPs to save for their retirement as it provides us with important tax advantages. The very first tax advantage is that there is the immediate tax benefit of being able to deduct your RSP contribution on your income tax return. So how does that exactly work? Well, we can take a look at this example here. So let's say your annual income this year is $40,000 and your employer will withhold tax based on your income of $40,000. But if you contribute $5,000 to an RRSP account, you will immediately reduce your taxable income to $35,000. However, your employer doesn't know how much you contribute, so your tax withheld through the year does not change. But at the end of the year, when you complete your tax return, you will receive money back from the government because the actual amount of taxes you need to pay should be based on $35,000 instead of that $40,000. So you can see, based on the progressive tax system in Canada, the higher your marginal tax rate and the more you contribute to your RSP, the greater the tax benefit. Okay, moving on to the next slide, please. Okay, so the second benefit of the RSP is that plan earnings are tax deferred. And this means that any growth or income generated by the investment in your RSP are not taxed as long as they stay in the plan. And we pay taxes only when you withdraw funds from the plan. And this is usually when we retired and are likely to pay less taxes at a lower tax rate. And because you can see that there are the tax advantages for the RSP accounts is very beneficial. So there is actually a limit on how much you can contribute each year. And the maximum contribution is calculated for you automatically by the Canada Revenue Agency. And this amount is actually reported on your notice of assessment. So for example, in 2022, you can contribute 18% of the income you earned in the prior year up to a maximum of $29,210 after any pension adjustments. But if you have any unused room from the previous years, you can carry that forward for another year. Also, it is very important to note that you can only have an RSP and contribute to it if you generate taxable income the year prior. And the taxable income can include employment income, business income, or net rental income. And for new Canadians, you should not open an RSP until after the first year of work in Canada. And there's something else that we can use RSP for. And the two other advantage of RSP is we can use it for the first-time home buyers plan, which means you can withdraw up to $35,000 from your RSP to buy or build your first home. And there is also another one for lifelong learning plan, and you can borrow up to $10,000 a year or $20,000 over 4 years. And both withdrawals for the home buyers plan and the learning plan are tax-free. So for today's session, it might seem complex, especially for the registered plans, but to make sense of it all, I like to compare investing to building a sandwich. So first, we need to start with the bread, which is the plan. And then we add the filling, which is made up of the investments inside the plan. So this could include mutual funds, stocks, or if you're more of a secured investor, then maybe term deposit might be the option for you. So as an investor, the first step is to figure out which plant types or bread are best for you. And then we fill them in with the investment that align with your risk tolerance for market volatility, and whether it's for income or if it's for growth. So this leads us to the second topic for today, which is the investment strategies that we can use for our investments. And there are three key investment principles that I will cover today. First one, invest early. Second, invest regularly. And the third one is about diversification. Okay, so we'll start with the first one, invest early. So starting early is one of the best ways to build wealth. Investing for a longer period of time is widely considered more effective than waiting until you have a large amount of savings or cash flow to invest. And this is due to the power of compounding. And compounding is the snowball effect that occurs when the dollars you earn investing generate even more earnings. Essentially, you grow not only the original amount you can invest, but also any accumulated interest, dividend, capital gains. So the longer you are invested, the more there is for your retirement returns to compound. So for example, if you made a RSP contribution of 10,000 today, and that RSP contribution could give you a dividend income depending on the investment you invest in, and that dividend income will invest back to the same investment. So there is that compounding effect there. And the next principle is invest regularly. So, and it's just as important as starting early. By investing regularly, your investment remains as a priority for you throughout the year, not just around certain deadlines like the yearly RSP contribution deadline. So having a disciplined approach can help you build more wealth over time. When you invest regularly, you can also ease into different type of markets, such as rising, falling, or when the market's flat. So you don't have to worry about trying to find the perfect time to invest. By simply investing a fixed dollar amount on a regular basis, you can buy more investments when the prices are low and fewer units when the prices are high. But this can potentially reduce the average cost of your investment over the long term. And another benefit is because we're all so busy with our own professional work, we might not have time to monitor the market daily or every hour. So investing regularly is the easiest and the most effective thing for us to do. So if you earn a regular paycheck, you can line up your contribution with your pay, making it easier to budget your savings. For example, if you receive a biweekly salary, it makes sense to make a biweekly contribution on your paydays, even if each contribution is a small amount, but you're paying yourself first and you're letting that investment and savings grow over time. Okay, and the final strategy we'll talk about today, it's about diversifying your investments. And diversification, as we all know, is often explained as not putting all your eggs in one basket. But why is this so important? So because different financial markets do not move in the same direction at the same time, and at various points in the market cycle, different type of investments or asset classes may respond differently to changes in environmental factors. For example, inflation and changes in interest rate are what we're experiencing right now. And also the outlook for corporate earnings is also something crucial to consider. And different asset classes or different industries perform differently based on economic cycles. Some industries are more cyclical, which means they move with the same direction as the economic cycle. And some industries are more defensive, which means they're not much impacted by the economic cycle. So when you diversify, you are better positioned to tap into different opportunities across different investments as they emerge. This tends to create a smoother investment experience. And to be honest, most of us will be concerned about losing money while investing. And one of the things we will ask about when we meet with our clients is to review your comfort level with market volatility and put together an investment plan that reflects it. We can put together a plan that prioritizes security, one that prioritizes growth, or find a balance between the two. So when you diversify, you're not putting your money in, you're putting your money into different investments or investment types, allowing you to benefit from the expectation of higher growth in some of your investments and greater securities with others. So your money actually grows quickly than if your investments were all secured, but you're not taking on more risk than what you're actually comfortable with. Okay, moving on to the next slide, please. Okay, so after discussing the plans and strategies, the intent for this event is really about you and how the advisors can work with you to help you reach your retirement goals. We're going to go through the 5 key questions you really should ask yourself as you plan your retirement. Okay, so we'll start for the very big question here. Next slide, please. So, are you ready for retirement? Well, most people assume to answer this question, they must first start by looking at their portfolio. But while money is important, that is not where the plan starts. I can help you fine tune your retirement readiness by walking you through some of the key questions you need to answer so you can begin to plan your retirement. Typically, the question I often hear is, how much do I need to retire? But before anyone can determine that amount, we need to think about all the other questions, including how will I spend my time? When should I leave work? How long should I plan for? And where will the money come from? And we'll look at each question individually. Next slide, please. Okay, so let's start with the first question. How much do I need to retire? Before we make a well-structured plan, we need to discuss the lifestyle we would like to have in retirement. And we are all going to have different lifestyles, which means the answer to the how much question will be different for all of us. But but what you can often hear in the media is that maybe we all need about 70% or even 80% of our pre-retirement income to maintain a comfortable lifestyle in retirement. But the reality is not so. So actually, when I help with my clients do investment planning or retirement planning, some of us are not going to need that kind of income and will be very happy with our chosen lifestyle. So how much will be impacted? So how much you need will be impacted by the answer to how you spend your time, when you will leave work, and how long you expect your retirement to last. And there is a very handy tool that individual can use, which is the My Advisor tool created by RBC. It is an online platform to help clients keep track of their financial goals. So clients can use that tool, and it's a very personalized tool to so you can see how much you might need to achieve a comfortable investment based on your own plans and your own expenses. Okay, next slide, please. Okay, moving on to the second question. How will I spend my time? So for retirement planning, starting by identifying your spending and lifestyle expectations in retirement. What is essential to you and what can you do without? So because we are retired, the 2,000 hours are given back to you. So what will we do with that $2,000? Will you spend more time with your family or spend more time on traveling? So that lifestyle will help you determine your expenses. So after we know our lifestyle, we should list the expenses you know you will have your retirement and versus how much income you will receive. And we must take all sources into consideration. And there will be unpredictable situations that come up. But with that proper planning, it will help you provide with a good starting point in your planning. And building a retirement budget is an important step to ensure your savings last. Okay, next slide, please. Okay, the next question is, when should I leave work? And for this question, there is something I want you to consider. Many people only think of the financial decisions when deciding to leave work, but we receive a lot more from work than just the money. For some of us, it is a purpose, and for some, it maintains such structure in our lives. And last but not least, many of our social connections actually come from work, and those work connections typically leave when you retired. So only you can make the emotional decision on whether you're ready to leave work, and it can be a far more difficult decision than money. A money decision can be quantified. An emotional decision is far more qualitative. So now this leads us to our next question. How long should I plan for? Next slide, please. So, since the 20th century, there has been nothing more significant than the increase of life expectancy. So, when we make our retirement plan, it would be more beneficial for us to use longer term for years in retirement to avoid the longevity risk. Sorry. And next slide, please. Okay, so the last crucial question to consider when planning for retirement is where will our income come from after our paychecks stop? So we'll look at our income sources from a very high level perspective today. And basically, there are 5 sources of income when you decide to retire, including the government retirement benefits, the employer pension plans, the registered retirement plans, personal savings and investments, and the lastly, other income that's not covered above. Okay, we'll look at each one individually. So we will start with the first one. Next slide, please. Okay, so the first government pension we will review today is the Canadian Pension Plan. Okay, so CPP is based on you and your employer's contributions during your working years. And the CPP is usually paid at the age of 65. And right now, the full pension is about $1,200 per month. And the pension is indexed so that it will rise as the cost of living increases over time. However, if you do decide to take the pension out early, you can, and you can take it out as early as the age of 60. But the pension amount will be reduced by 0.6% for every month prior to your 65th birthday. So if you do want to apply on the 60th birthday, there will be an overall reduction of 36%. And on the other hand, if you have sufficient income or or sufficient assets, you can also delay receiving the CPP pension plan. And by delaying that, your overall CPP will increase by 0.7% a month for every month after the 65th birthday. So if you apply on the 70th birthday and do the math, that will be a 42% increase. But once you make that election, it is final. So it is better to calculate your CPP pension and have all your income sources before we make that final decision. Okay, so the amount of your CPP retirement pension depends on different factors, such as the age you decide to start your pension, how much and how long you contributed to the CPP, and the average earnings throughout your work life. And because everyone gets a unique amount of CPP based on that amount they contribute to CPP while you are working. So the more you put in, the more you'll get out. Okay, so the next one for the government pension is the old age security. And different from the CPP plan, the old age security is based on the residency and not the contributions made on by you. So if you're living in Canada, you are eligible to receive the CPP, and there are some criteria. So the first criteria is you need to be at least 65 years old or older, be a Canadian citizen at the time we approve get approved the old age security pension application, and also you have resided in Canada for at least 10 years since the age of 18. But if you're living outside of Canada at the age of 65, you can also qualify for the old age security. But the qualification is even more strict. So you have to be a Canadian citizen before the day you left Canada, and also you have to reside in Canada for at least 20 years since the age of 18. So the maximum at old age security is approximately $640 today, and you receive it at age 65. But you can also delay receiving that pension up to your 70th birthday, and the calculation is the same as the CPP calculations. And there is actually a new rule starting July 2022. So based on the new rules, seniors age 75 and over will see an automatically 10% increase in their old age securities. And in order to qualify for the maximum pension, you will have to have lived in Canada for at least 40 years after your 18th birthday. Okay. So for the old age security, there's something very important that we need to pay attention to, and that is the clawback rule. So if your income is higher than a certain amount, you will have to repay part or entire of your old age security pension. And next, we'll cover the employer pension plans. There are two pension plans available. The first one is the defined benefit plan, and it is usually expressed as a percentage of income based on the years of your employment and income. While you may contribute to the plan, but it is your employer's responsibility to ensure the plan is funded to a level to meet that promised payout. So the risk is your employer's instead of yours. And there's usually a formula for the defined benefit plan based on your salary, years of service, and potentially your age. But because of the unlimited funding risk, now we only see defined benefit plans for government workers. A lot of different roles offer, or different jobs offer, defined contribution plans now. So with the defined contribution plan, as the name suggests, the amount of contribution, both yours and the company's, is defined. Also, typically, you determine the investment from a predefined list. So usually, it is usually a mutual fund solution or portfolio solution. So you are in charge of investing that money. And the pension income is not predetermined, but the contributions are. Basically, what happens is that when you retire, you take the money and all the accumulated earnings and buy yourself an income stream. And the size of that income stream will depend on how much money is in your plan. And then, of course, there are your personal investments. Those are the investment you are able to accumulate during your working years. And these include RSP plans that we've talked about today. And you can also use tax-free savings account to accumulate your retirement resources as well. And there are other non-registered accounts that you can open. So they can be turned into an income stream when it serves the purposes. And finally, there is the other income. So this could be rental income, or even employment income. So because a lot of us choose to go back to the workforce after they decided to retire. So after knowing all these inventory for potential income sources, we can start the journey of creating our own retirement paycheck. So we take the inventory of your potential income source, consider how much you will come from each source and in what order, determine if this will meet your retirement income needs, and then finally, you can talk to your financial advisor to ensure your current investment and retirement income strategy will keep you on track to meet your goals. Okay.
Awesome.
All right,
Perfect.
so that's all I have for today. Thank you everyone for listening and taking your time to meet with us today.
Awesome. Thank you so much, Maggie, for the great presentation. I was busy taking my notes already. so thank you so much. You share so many great tips and advice. You know, as RRSP season, we get so many questions about the RRSP, and I'm sure you answered already so many questions, right? And I love the sandwich example, you know, like how we need to just pick the bread as we have different type of registered plan, and then fill it in later on with different type of investment that aligns to the diversity. As you said, diversity is very important. I'm so glad that you brought up the 3 key investing principles. You know, like I always say, that is never too early to think about retirement. It's not about your age, if you're 20, 30, so it's never too early to think about retirement. And as you said, starting early is really important, and that's the best way to build wealth, because of due to the power of compounding, right? And about the diversity, how important is the diversity. And I'm so also glad you touch on the My Advisor, which is a great tools available at RBC Online Banking. So if you're RBC clients, you can easily access to these great tools. It's very personalized tools that you can track and meet your financial goals. So if you don't know how to use it, just feel free to reach out to us. We can definitely guide you. Is a very great personalized tools, as well as, you know, the 5 keys questions that we all need to ask ourselves. Sometimes I ask my clients, are you ready for retirement? I said, okay, I have no idea. Like sometimes they said, I'm just 20 years old, I'm just 30s, I have no idea. And as you just mentioned, it's really also important that we know about the inventory, and we know about how the money gonna come from. So like, what are the sources of retirement? And you just explained it very well, that we going to have different type of, you know, sources, resources for the retirement, including our resources like the account that we can open, RRSP account, but as well as like the CPP or like old age security. And I saw already some questions about this kind of resources. So again, thank you so much. I learned a lot personally myself. So, and now let's get to the question. I love seeing questions coming on the chat box. So I'm going to start. And the first question, and for the attendees, so if you can just enter your questions in the Q&A instead of the chat box would be great. So let's just start with the very first question from Ahmed. So can the beneficiary choose the business in which RBC can invest or does not invest?
Okay, that's a great question. Thank you for your question, Ahmed. So by business, you mean the investments, right? That you want to invest inside the investment plan. So typically the account holder of the RSP make that decision. And for all registered plans in Canada, the account holder is able to designate the beneficiary of that account. For example, you can designate your spouse or maybe your children to be the beneficiary of the account. But the beneficiary plays the role of taking benefit of the or maybe taking over the plan, knock on wood, after the death of the account holder. They typically do not make that investment decision. But however, if you want the beneficiary to make investment decisions on behalf of you, there are certain things that we can do. For example, you can designate that beneficiary as a trading authority. So in that case, we can take the trading authority's instruction to make to do the trading or to make that investment. Or you can also have a joint account, but joint account can be only open for non-registered accounts, but not registered accounts. Does that answer your question?
I think so, Maggie. And then Ahmed saying that yes, the account holder. He meant like the account holder.
Okay.
But perfect. Yeah. Yes, you explained it very well. Thank you so much, Maggie.
Yeah,
so
no problem.
Another great question from Ayush. So what does it exactly mean, open RRSP only after first year? Let's say if a person started working in, let's say, October 2021, will they be able to invest in RRSP starting November 2021 or January 2020? Sorry, November 2022 or January 2022?
Yeah. Okay. Another very good question. So, okay, so let's assume that you started working in October 2021. That means you would have to report your taxes around March, April 2022. In that case, you will be able to contribute and open an RSP plan after you finished your tax reporting. So because you will only know how much you can contribute to the RSP once you get your notice of assessment back. So, but once you have your notice of assessment, you will be able to open that RSP account and contribute to it. So you don't have to wait until November 2022. After you report your taxes, you will be able to know how much you can contribute.
Thank you so much, Maggie. I guess you already answered a Vikram question also. Like Vikram also asked, what does the start after first year mean? So,
okay.
Perfect. And so Ayush has another question. Is withdrawal from RRSP for first home buyer taxed at all?
It is not taxed. So that $35,000 is completely tax-free. You don't pay taxes on that amount. So it is a very, very good advantage for that RSP account. However, you do have to repay back that $35,000 you took out, and it is over your period of 15 years. So you have a lot of time to repay that back. And $35,000 is the maximum. You don't have to take $35,000. You decide on how much you want to take out from the RSP account.
Exactly. It's a very great program. I actually took advantage of first home buyer RSP withdrawal myself in 2015. As you said, you do not have to do the maximum, which is 35,000. I just took like 10,000, and 2 years later, I received a letter from the government that I need to start paying it back. So it's very easy to manage it. So I'm starting like they divided by 15 years, and you need to just pay back that small amount per year. All right. So another great question from Ahmed. Is retirement income taxable? Any tax benefits related to retirement income?
So retirement income, depending on how do you define retirement income. So there are, as I mentioned earlier, there are different sources of retirement income, including the CPP, the old age security, your own investments, and maybe some employment income. So for the CPP, old age securities, those are considered taxable retirement income. And if you withdraw from your RRSP to fulfill your retirement income, that withdrawal is also considered as a taxable retirement income. However, if you take money out from a tax-free savings account to fulfill your retirement cash flow or income, that withdrawal is not considered as a taxable retirement income. So depending on the sources of your retirement, some are fully taxable, some are not taxable, and some are partially taxable. Especially taking money out from a non-registered account, the tax implication can be very complex. So before you do any withdrawals for your retirement income, I would strongly recommend you talk to an advisor first, and that advisor can provide you some high-level tax implications, and also you can work with an accountant to determine the most efficient retirement income source.
Great. Ahmed said, thank you, Maggie. Thank you, Ahmed, for the great questions. So the next two questions is about CPP and older security. So if you're eligible, will we get both CPP and older security at the age of 65?
Yeah, you will. So if you're eligible, you will get both CPP and old age security at the age of 65.
Perfect.
Yeah,
and
you
Nishan,
can, yeah.
And
Sorry,
Nishan
go ahead.
wants to know. Okay, sorry. Nishan wants to know if CPP is fixed at 1,200 Canadian if we take it at 65 years old. So could you please explain how we can become eligible for this?
Okay, so the 1,200 is actually the maximum amount. So it is not the fixed amount. As I mentioned earlier in the presentation, that everyone will receive a very different CPP amount, and that amount is based on your own contributions and the years of working. So it is very different based on the individual. But what I can tell you is that in order to receive the maximum CPP payment, which is about $1,200 per month, you need to be making 39 years of maximum contributions between the age of 18 and 35. So it is pretty difficult to get that maximum CPP payment. And something else you can do to determine how much CPP you can get before the age of, before you want to receive that amount, is you can request CRA to do that calculation for you. They will give you the most accurate estimate.
Perfect. Thank you so much, Maggie. Another question about the RRSP interest. What is the interest rate on the RRSP?
Okay, so that's a very, very good question. So it might be a bit complicated for some of us or for some people, but what the RSP is, it's actually a plan. So it's an account type. But within that RSP plan, you can decide on what type of investments you want to invest in. So for example, you can invest in a GIC or like a term deposit. That one is secured. There will be a determined interest rate. But you can also invest in portfolio solutions or mutual funds. Those will have some risk to it, but the price fluctuates, but it grows more over time. So because this is a retirement savings and investment, we want it to grow over time and be able to beat inflation. So maybe putting into a savings account or a GIC might not be the good idea. So there really is no certain interest rate associated with the RSP. The RSP is just the plan, and what you wanted to invest in is the decision you need to make, and you can work with the advisor to determine your risk tolerance.
Perfect. Thank you so much, Maggie. Neha would like to know more about My Advisor. My Advisor tool can only used by RBC clients or any other persons. So I can answer this question. So yes, so my advisor available through your online banking if you're RBC client is a great tools. But even if you're not RBC client, so you can ask your respective bank. So they may have the kind of similar tools, maybe under different names. But yes, my advisor only available for RBC clients. All right. So another question from Navi. Navi would like to know that for the RRSP, any growth earned if it's not taxed until withdraw, for example, a retirement. So does that mean that we all ultimately you are taxed?
Yeah, so the short answer to this question is yes. Automatically, you are taxed. However, well, maybe not 100%, but depends on your retirement income. Because let's say, for example, right now let's assume that we're all working. We will be at a tax bracket based on our current income. But when we retired, usually our income is lower than what we are compared to when we are working. So that is that benefit. And there's another type of account which we didn't really cover in details today. That is the tax-free savings account. So that is also another account you can leverage to accumulate your retirement income source. And in the future, if you withdraw funds from that tax-free savings account, you are not getting taxed at all. So those are the two type of accounts that you can leverage. And even non-registered, you can leverage to start saving for your retirement.
Okay, great. So another question from Ayush. How does the 40-year residency requirement kick in for a new resident if they landed at age of 32 and started working immediately?
Yeah. So, okay, so let's at the age of 32 and you started working immediately. And let's assume that you will retire at the age of 65 and you decided to start taking old age security at the age of 65. So by that time, we do the math, you will be in Canada. Let me do my math quickly. That's about 33 years. So the amount of old age security you will get is a prorated amount based on the 33 years. So we use 33 divided by 40, and then we multiply by the maximum old age security amount. So you'll be getting a little bit less than the maximum, but still a lot.
Perfect. Thank you so much.
Okay, no problem.
And then another question about, about like Islamic finance principles, right? So one of our attendees would like to know that can the account holder adjust the investment strategy to comply with Islamic finance principles? And have you had clients requesting this adjustment to the investment strategy? Very great question.
Yeah. Very, very good question. Yes, for sure. And at RBC, we do have our Vision Fund family that really follow the Islamic finance principles. And what the Vision Fund family is we focus on company that has high ESG factors. And if you have any questions in regards to the Vision Funds, we can discuss in details. But at RBC, yes, we do provide clients with that type of request.
Perfect. Thank you so much, Maggie, for answering that question. So can I put my maximum RRSP contribution room into my spousal RRSP?
Yes, you can. You can open a spousal RRSP and contribute to that RRSP as long as it's within your own RRSP contribution limit. So yeah, by doing that, I would assume that your spouse will be in a lower tax bracket when you guys are retiring. So that is something, that is another strategy you can use. Yeah.
Exactly. So you're welcome, Navi. The last question is actually a very broad question. So we have a few more minutes. So Neha would like to know, what are the good stocks or EFTs or mutual fund, where can we invest, where we can invest for the good returns?
Okay, so with the ETFs and mutual funds, so let me just quickly provide you a big a comparison between the ETFs and the mutual funds. So ETFs are some of the passive investment vehicles, and they are not as diversified as mutual fund solutions or portfolio solutions. So investors with more investment background or more experience may choose to invest in ETFs, but because it's passive investment strategy, the companies inside that ETF is not usually, it doesn't really change, and it's more focused in a certain sector. While mutual funds are more diversified and the strategies used in the mutual fund solutions are more active. So at RBC, we do have both type of options for clients. So for the mutual fund and the portfolio solution, what we provide to clients are our classic select portfolios. If you are someone who wants to have a diversified solution and wants to have that active management in your investment. And we also have the index funds. Those are typically investments with lower management expense ratios, but also those index funds are focused in a certain region. For example, we have Canadian index fund and US index fund. And what we can also work with you is to create a customized investment portfolio that includes both the portfolio solution and the index funds and individual mutual funds. So there are a lot of mutual funds out there. It is very hard to provide one or two examples, but if you have questions with RBC's investments, I'm happy to connect with you after the session to provide you some examples.
Awesome. Thank you so much, Maggie, once again for answering all of